Good morning and happy Wednesday to all. I'm Matt Stranix and this is 5 Minute Finance. I'm here once again with Luke Chapman and we've got quite the discussion lined up for you today.
Thank you, Matt. And yes, we do. Today, we're going to be discussing the effect of long-term compounding growth in your investments. Now, just to be clear, all rates of returns, time periods, and investment amounts being discussed were chosen simply for illustrative purposes. Actual investment performance will vary. Matt, with that out of the way, go ahead and talk to me a little bit about compounding growth.
Sure. Thanks, Luke. So compounding growth is the idea of our initial investment making money and then that money making money and so on. So this is often what people are referring to when they're saying, put your money to work or let your money work for you. Now, let's take a look at this chart. This chart is illustrating a $10,000 beginning account balance that receives a 6% return each year for 30 years. At the end of that 30 years, that $10,000 beginning balance has grown to more than $54,000.
By looking at this chart alone, why does it look like all of the growth comes from later years? You said 6% every year.
So that's the magic of compounding growth, Luke. I already said that every year experiences the same annual return of 6%. In the first year, 6% on the beginning balance is only growth of $600. But when you get to that final year, 6% on the accumulated balance is an annual growth of more than $3,000.
All right, Matt. If many listeners of our at-home audience are thinking about this in the framework of saving for retirement, which they likely are, what are one or two key points they should be aware of?
Well, you know us, Luke. This isn't general advice. Each person, each family, each organization is different. Not all retirement savings plans and not all retirement income plans should be built the same way. However, let me challenge you to think about this a little differently. In line with the usual way of thinking, what do people typically do with their investments as they get closer to retirement?
Well, they typically get more conservative, which means they're expecting a lower amount of return because they're taking a lower amount of risk.
Exactly. Now, I'm not saying retirees and pre-retirees should be in extremely aggressive investments, but I do want to point out what a dampened down growth rate can do to a retirement portfolio. So let's take a look at another chart. Here, we've got a $250,000 value for all three scenarios. The blue line reflects a 6% annual return every year for 30 years. The orange line reflects that same 6% annual return for the first 15 years. And then this person got more conservative and only received 3% annual return for the latter 15 years. The gray line reflects someone who was really afraid to take on market risk from the beginning and only received 3% annual return for all 30 years.
Wow, based on that graph, it looks like a pretty glaring difference in end results.
Yep, that's exactly right. So the person who stayed more aggressive and received 6% per year had an ending account value of more than $1.3 million after that 30-year period. The person who got more conservative halfway through, they had roughly $500,000 less than the first person. And finally, the person who was afraid to get invested from the beginning, they didn't even break an account value of $600,000 after that 30-year period.
Wow, Matt, thank you so much for that analysis. I think, again, the overarching message here is to understand the underlying power of compounding growth so that you and your financial planner can discuss the appropriate investment strategies for you and your family. That wraps up this episode of 5 Minute Finance. Thank you. Tune in on the first and third Wednesdays of each month for new content. Be sure to like, comment, and share to help spread the financial education. Thanks, everybody.